This is Account 302, and this is the intro to bond accounting. So, with this video, you want to have the lecture note available so you can mark it up and follow along. So, the front page, we have an overview of what you're going to be learning, and even though it's long-term liabilities that we're talking about, let me change my pen color here. It's actually just bond accounting. Okay, so for long-term debt, a bond is a long-term debt. It's a marketable long-term debt. We'll talk a little bit more about that, but that's what causes the complexity, is that it is a debt that can be bought and sold on a public market. So we're going to deal with the issuance. How do we, when do we, and how do we measure interest expense? What happens if we retire the bond prior to maturity, so you pay off your loan before the maturity date? And then, so these A, B, and C, these are the big pieces here. And kind of detail we have to take care of is bond issue costs. So investment banks issue bonds, and they get a fee for that. How do we deal with that? Okay, so with issuance of the bond in particular, we're going to talk a little bit about loans briefly, but really marketable debt security, which is a bond. You're issuing the debt to receive cash, so you're going to increase cash. You're going to credit a payable, in particular a bond payable or bonds payable. And then you may end up to adjust for the value of the bond that's distinct from the principal value. You may have to credit premium or debit a discount account. For the accrual of interest expense, we're going to use the effective interest method. I don't know if you hear that ding. I hear it. So let me just pause this a second. Okay, and I'm back. It was my email dinging. I don't know if it recorded or not, but I just wanted to get rid of that distraction. So, this effective interest method, so we're talking about the accrual of interest expense. When you've dealt with loans in the past, the interest payment and the interest expense accrue at the same rate. But when we have marketable securities, the rate at which the expense and the payment accrue are going to be different. We're going to use this effective interest method. It's a method that's used in other places in accounting, in particular your next subject leases. So this is a method that you're very likely to run into in practice, and you will see over and over again in courses and the CPA exam. So this method accounts for the differences between the rate at which interest payments and interest expense accrues. The straight line method is also acceptable but not preferred. So we will have some problems with the straight line method, but obviously you shouldn't have such a big issue with that. It's straight line. And then retirement prior to maturity. We're going to have a gain or a loss. So like when you sell property, plant, and equipment, you have a gain or a loss. It's similar, except here you're paying off a debt early. So if, let's say if you had a car loan and the bank let you for $20,000 and the bank let you pay it off for $18,000, that'd be good. That would be a gain. If you had some car loan and for some reason you paid it off for $22,000, that would be a loss. So we'll see retirement of these obligations can result in gains or losses. The second part here, and it's really these off-balance sheet items, it's really a one page and just a heads up. We're just going to talk about some examples briefly. In practice, these off-balance sheet items are a huge deal. There's a lot of expertise that's utilized in trying to get items off the balance sheet. So off-balance sheet items, they're things that are economic obligations or potential economic obligations, but they aren't in fact recorded or recognized as liabilities. So in the accounting world, you could have an entire, well, in school you could have an entire course on those. We're just going to point out 3 separate transactions and just give you a little heads up on the issue. Okay, this example number 1 is really just a refresher of loan accounting. It's trying to, for those of you who haven't done loan accounting or recently, or it's not fresh in your mind. So this is just a loan payable. So this isn't a bond. It is a long-term debt, long-term liability. So Sophia Software, they get a loan from Evil Bank with a principal value of $240,000. Annual interest rate 10%. Semi-annual interest payments. And of course, I say they're in arrears, but that's loans always have interest payments in arrears. But just to be clear, and they're due on September 1 and March 1. So we'll have a little partial year adjustment. And the full maturity amount is due on March 1 of FY4. So this is an interest-only loan with the full principal amount due at maturity. So this is unlike your car loan or a mortgage loan where you make one level payment every month and part of its interest, part of its principal. That would be a mortgage loan, or a car loan would be an amortizing loan. This is a non-amortizing loan. So this is non-amortizing because the principal is not reduced over the life of the loan. All right, and this is asking us to record the issuance of the loan. So initial recognition, calculate the interest, semi-annual interest payment, record the journal entries for the payments, and record the payoff. And I guess with number 2, right here, also record that adjusting entry for interest expense. Here's the issuance. You're receiving cash and you're issuing a note, which is a promise to pay. Where does the interest expense come from? So we issue on March 1 and we have a September 1 payment. It's $240,000, the principal, times the annual rate, times March, April, May, June, July, August. That's 6/12. So 240,000 times 10% is 24,000 per year, but it's only half a year. So each interest payment is 12,000, and this is a normal entry. You pay cash and recognize the associated interest expense. Now we get to our adjusting entry. 240,000 times 10% times September, October, November, December. 4 months since the last payment, over 12 months for a year, and that's where the 8,000 comes from here. And when we make the $12,000 payment on March 1 of the following year, we reduce the payable, and this 4,000 is, another easy way to do it is to recognize how much per month. 240,000 divided by 12 times 10%. So that's 2,000 per month. 2,000 per month. So this is March 1st. So it's January, February. This is just 2 times 2,000. Okay. So for the March payment, we recognize another 2 months of interest expense. And then after that, it just keeps cycling through the same journal entry. 12,000, 12,000, 8,000, 8,000, 4, 8, 12. 12, 12, 8, 8. And the final journal entry, you still remove your payable, recognize your last 2 months of interest expense, but then you also have the principal payoff. So you remove the note payable that you had credited at the beginning. So this is a loan. So that's just a loan, and pretty much that's all we're going to say about that with the loans. Okay. Next, we're going to deal with discounted loans, but it's really just to transition us to bonds. So in the next video, we'll start with discount loans.